This chart shows the price of gold over the last several decades. After tracking relatively steady for years, the line violently spikes, crossing the $5,000 mark. Look at the bars appearing underneath. These represent central bank purchasing volume. These institutions, not individual investors, are suddenly hoarding over 1,000 metric tons a year. The demand is heavily concentrated in emerging economies. The central banks of Poland, Turkey, and India and China have become the most aggressive buyers on the market. China accelerated its acquisitions. In early 2024, the People's Bank of China bought more gold in a single month than in over a year. The very institutions responsible for managing the stability of modern fiat currencies are quietly stocking up on the world's oldest physical asset. That volume of buying signals a deep, systemic anxiety. It wasn't always like this. In the late 1990s, most central banks were actually selling off their gold. It was widely viewed as a clunky, old-fashioned relic with too many practical disadvantages compared to holding modern digital reserves. But a compounding series of shocks, starting with the global financial crisis and extending through recent wars in Ukraine and the Middle East, eroded their confidence in paper bonds and digital networks. In times of severe stress, countries realized they needed a liability-free asset. They needed something that is universally recognized, globally liquid, and crucially, does not rely on the promises of another nation to hold its value. To protect their local economies, nations are stepping back from the fragile promises of the interconnected digital economy and wrapping themselves in a heavy, physical shield they can control completely independently. We can see this defense strategy playing out right now. Under Governor Głupinski, the National Bank of Poland rapidly expanded its stockpile to a massive 580 metric tons, valued at roughly $85 billion. Turkey utilized a more active defense. When severe inflation caused the Turkish lira to plummet, their central bank successfully sold or lent more than 120 metric tons of its gold to prop up the currency. But acquiring and trading this kind of wealth means dealing with the shocking physical reality of the metal itself. A single metric ton equals 2,205 pounds. Multiply that by hundreds or thousands, and a central bank's reserves become unimaginably heavy, incredibly cumbersome, and an obvious target for theft. Which poses a serious geographical paradox. If a country acquires thousands of tons of physical metal to protect itself, where exactly do they put it? The utility of gold as an independent financial shield is entirely dependent on the physical security of its storage location. For over a century, the answer to that problem has been to rely on the historic guardians of global wealth, the Federal Reserve Bank of New York and the Bank of England in London. The vaults beneath the New York Fed currently house more than 500,000 gold bars. It remains the largest single store of monetary gold on the planet. Because New York and London sit at the center of global trading hubs, countries can buy, sell, and trade massive volumes of gold with each other without ever having to load a single bar onto a cargo ship. Both institutions also boast unmatched security records. Gold has never been stolen from either vault. During World War II, the gold in London was secretly relocated across the Atlantic to Canada to keep it perfectly insulated from the conflict. For generations, outsourcing your physical wealth to a trusted foreign vault in the West was the undisputed safest choice a nation could make. But storing gold abroad to escape financial risk actually creates a new, very modern vulnerability. By keeping their ultimate safety net in New York or London, nations expose themselves to potential sanctions and political leverage from the West. Former Venezuelan political leaders are locked in a long-running court battle, blocked from reclaiming their sovereign gold reserves from the Bank of England's vaults. And that fear of asset freezing is no longer limited to adversarial nations. Aggressive rhetoric from leaders like Donald Trump has even caused traditional European allies to sweat over the safety of their overseas reserves. The physical asset meant to guarantee complete independence has morphed into a geopolitical hostage, forcing countries to reconsider their trust in the West. This breakdown in trust has triggered calls for repatriation, with lawmakers pressing to pull their gold out of foreign vaults and bring it back home. Germany and Italy defensively split their gold reserves, keeping half at home and the rest in New York and London. Globally, while legacy Western banks hold historical majorities, massive arrows show new purchasing power is heavily concentrated in emerging markets. The physical location of the world's gold acts as a live map of international anxiety, revealing exactly who the world trusts in an increasingly unstable era.